taking this into a scenario where you can turn this into a larger trade. This is where understanding the directional or swing bias within a market is going to give you an opportunity. So let's take something like this. This is an S&P trade. And a lot of people like trading S&P. To be fair, most traders at Axia like trading S&P. This is a trade then, nice and simple. What you've got is value lower, expectation of a liquidation move higher. I'm not going to go into the details of why these things happen. That's something for another session, something for the future. But you've got this idea here, right? So the play basically is break the initial balance, sweep up through this zone towards the upside. In doing that, you're going to run up towards 52, 53. That's the big trade, right? So as a swing trader, you're looking for that and potentially more. After that, then you could be potentially going towards the highs of the day up towards 70. So by understanding what the swing trade is, you also understand where the action's going to come on this. As a swing trader, though, understanding how to scalp is going to make you much better at executing on this trade. As a swing trader, the general thought would be get up above this zone, get up above the initial balance high, try and buy it somewhere, stop down here. But if you've got a better feel for the way the market moves, you have much more ability to judge this better, give yourself much better and more accurate entry points. So if we go and have a quick look at this, I've done, and some of you guys will have seen on YouTube, I put out the actual break part of this trade. So go check that one out on YouTube. But what I'm going to be looking at here is if you get a breakout, and the first breakout is then going to be above the initial balance high at 22.25. If this happens and doesn't work, how do you deal with this? What information does that give you? So let's go have a little look. What we're looking at then is this first break here. So this is the bit that people are going to be trying to get onto. And as a swing trader, I think as a swing trader, a lot of people are going to look at this and think, well, you buy the break of 22. What do you do about it when it comes back? Now, what I'm suggesting here is mastering scalping or becoming a better scalper will mean that you understand better how to execute, how to get into this trade. Right. So this is the initial break. Now, what I'm watching for as a scalper, I'm looking at where things change, where the market accelerates, where it sort of picks up a little change. What we've seen there, skips above 18.5 and then 20. 20 was the point where it really quickly jumped. Now, if you're trying to play that break, super fast move, you're going to really struggle to get onto that. So what I'm looking at now is, right, where can I buy this on a pullback? 23 is an option. And so that's one place that you could try and buy it. You get the pullback towards 23, you can have a go at buying it there. But again, when it goes up, it struggles at 25. Back towards 23, you don't get filled. And because it's no longer then moving towards the upside, I'm now starting to think, do I really want 23? I'd certainly prefer 22. But also the acceleration came from 20. So to improve your execution for the bigger move, actually more what you want to understand is that initial move. So as a scalper, you get that detail. You see that the acceleration came at 18.5, tick up, jumped through 20. That was where the big change comes from. So now if you're a swing trader, yes, it may only be marginal, but you can improve your execution quite significantly here. Comes back, you can get in at 20. You also know that because the very early little push higher came for around 18, your stop can go just below 18. So you're making much more accurate entries, much more accurate, tighter stops on your swing trades because you understand the way the market moves from a scalper's perspective. You see there, trades 18, a little bit slow on the attempted entry, but now you've got that stabilization. The market has come back, traded 18. The only difficulty that you're going to face now is whether it actually goes and breaks the high. But by getting in here, what you're giving yourself is the opportunity to be in for when it does break the high. That's the way that you're looking at these types of trades. But What it also means is if it does fail to break the IB again at 22.5, that's fine. You're already in from 20. You're safe on this trade. We shouldn't be seeing this back down below 20 now. And remember, I talked about 23 off that initial jump up. Look where it's currently sticking. So you now know that the the result of this trade is going to depend on whether we can get over 23. If it can get over 23, you've now also got a chance to add to the trade as well. So it's using that sort of very micro view of what's going on, that feel for the ladder, to be your chance now to try and get into a trade, leverage the trade up. You know now that having bought 20, you've got the opportunity to buy at 22.25, 23 area. It shouldn't be coming back below 20. You're now in a good position to get yourself in, ready for that bigger breakout. Where do you place your stop? No, you don't see it on a ladder. As a scalper, I wouldn't place a stop, right? I was just explaining the way it traded back down towards 18, because that was where the origin of the move started. I would want to stop below that. But I want to look at the way it trades when it gets there to tell me whether I think it will actually go through. If this, for example, trades 20, 17.5 and jumps back to 18.5, I still want that trade, because that strikes me as a quick whip down, a little bit of panic, and that's not enough to get me out. The last thing I want is to be out of the trade at that point in time. And that's comes from that skill, that feel for it, that sort of scalping skill that you gain. That's why I wouldn't place a stop. Hardly any traders actually place stops. You know where your stop is. If this trades down to 17 and it doesn't bounce back really quick, I'm talking very, very quick, flash down, flash back, I'll get out the trade. That's the way that I'd be looking at something like that. I know people always look at sort of where do you place your stops on trades. Most traders will never have a stop place. They know where their stop is, and they've got the discipline then to stick to the stop when it comes back down. But all of that gives you an improved entry. It means that when it finally goes and breaks 26.25, which was the initial jump up, then you're already in now. Breaks 26.25, the trade is on. You can't use only footprint for these, because what you can't see from footprint is how the other orders are transacting. That's the bit you can't see. If you take, for example, that previous one we looked at, you may be able to say, yep, somebody's absorbing that on a footprint. What you can never know, though, is the clue that comes from the passive bids, because they didn't trade. They spoofed the market. That's what tells you this is definitely worth taking on. This is one to leverage up. Without a price adder, you can't see that, because the footprint only shows you what's just traded. Laser eye on that point, nobody's flushing the market down to get you out of a trade. This is something I'll perhaps cover in a short in future, but quite simply, it's not in anybody's interest to do that. And it is too costly for them to hit your one lot or two lot stop.